All right, welcome back. Today we're diving into something that, let's be honest, haunts every single quant trader out there: overfitting. We're going to break down how you can build trading strategies that actually work in the real world, not just look pretty on paper. So, let's jump right in.
Does this sound familiar? You spend weeks, maybe even months, building what you think is the perfect strategy. The backtest looks incredible. That equity curve is just a beautiful, smooth line heading straight for the moon. You're feeling good, you go live, and poof, it just completely falls apart. If you know that feeling, then you've run headfirst into our topic for today.
So, what is this invisible enemy? Well, it's called overfitting. And the best way to think about it is like this. Your strategy hasn't learned a real market edge. Instead, it's become a master historian of market noise. It's memorized every random blip, every weird fluctuation, every one-off event in your historical data. It's perfectly built for a world that, well, it doesn't exist anymore, and will never happen again in exactly the same way.
And that, right there, leads us straight into what we call the overfitting trap. It's so easy to fall into because honestly, it feels like you're doing the right thing, like you're making your strategy better and better with every tweak. And this right here, just nails the core problem. When we keep tweaking and optimizing our parameters to get that perfect, beautiful backtest, what we're really doing is optimizing for a pass filled with random noise. We're curve fitting. And this creates a strategy that's incredibly fragile, so brittle that the second the future looks even a little different, the whole thing just shatters. Okay, so how do we fight back? How do we escape this trap? Well, we need a toolkit, a robustness toolkit. Let's talk about some foundational techniques you can start using right away to build a much more solid strategy from the ground up.
All right, rule number 1, and this is probably the most important one: restraint. Every single new parameter you add for optimization, another moving average, an RSI level, a stop loss, it exponentially increases the chances of finding a totally meaningless correlation. You're just giving the computer more and more chances to find fool's gold in the random static of the market.
So here's the big takeaway, the magic number to keep in your head. Try to stick to optimizing just 2 or 3 of your most critical parameters. Ask yourself, which inputs have the biggest impact on my strategy's core logic? Focus on those and keep everything else fixed. Seriously, this one simple rule alone will slash your risk of overfitting.
And building on that, we've got to be logical, right? Your parameter ranges shouldn't just be random. I mean, if you're day trading, does a 500-day moving average make any sense? Probably not, so don't even test it. Same thing goes for your step size. Is the market really going to behave differently between a 20 period and a 20.1 period indicator? No way. That's just noise. Use bigger, coarser steps, like increments of 5 or 10, to find real distinct zones of performance.
Now, this next one might feel a little counterintuitive. We're all in this to make money, obviously. But, and this is a big but, optimizing only for the highest net profit is one of the quickest ways to build an overfitted strategy. Because that one giant profit number, it can be hiding some absolutely terrifying, account-blowing risks underneath. So instead, we need to shift our focus. We optimize for robustness. We use metrics that tell the whole story. Things like the Sharpe ratio, which looks at return versus risk, or the Kalmar ratio, which compares your return to your worst drawdown. Even a simple profit factor is better. These metrics reward consistency and stability, not just some single lottery ticket outcome.
And all of this really brings us to a core philosophy, a huge shift in mindset. It's about learning to value stability way, way more than you value that one single peak performance. This, right here, is what separates the pros from the crowd.
Okay, now this slide is so important because it perfectly visualizes this mindset. Over on the left, you see the isolated peak. That's when one specific parameter set gives you amazing results. But if you change the parameters just a tiny bit, performance falls off a cliff. That is a massive red flag. It's fragile. Now look to the right at the performance plateau. This is what you're hunting for. It's a whole region, a whole neighborhood of different parameter sets that all perform pretty well. That's robust. That's resilient. That tells you you've probably found a real market edge, not just random luck.
And this quote just nails it. You have to train your brain to see that one single best backtest not as a prize to be won, but as a potential warning sign. That second best, or third best, or even 10th best result that sits comfortably in the middle of a stable plateau, that is almost always the better choice for live trading.
So, you've used all the foundational tools. You've found a promising performance plateau. Are you done? Not even close.
Now it's time to put your strategy through the ringer, to run it through a brutal validation gauntlet to see if it's really got what it takes.
Okay, the first, and honestly, the most critical test of all, is out-of-sample validation. This means you have to hold back a chunk of data that your optimization process has never, ever seen. It's a clean test, and if your strategy looks great on the data it was trained on, but completely falls on his face with the new unseen data, well, you've got to go back to the drawing board. It's a classic sign of overfitting.
Now we can take that a step further with something called walk-forward optimization. It's a more dynamic process. You basically optimize on a block of data, say 2 years, and then you test it on the next unseen block, maybe the next 6 months. Then you slide that whole window forward in time and do it all over again. This much more closely simulates how you would actually trade and adapt over the years, making it a much more realistic test.
And finally, you have to throw some chaos at it. How does your strategy hold up during a black swan event like the 2008 financial crisis? What about a flash crash? You've got to stress test your system against these extreme market conditions to find those hidden vulnerabilities before you put your real capital on the line.
Look, building a robust strategy is one thing, but managing it successfully for the long haul, that's a whole other ballgame. And it all comes down to discipline and a few non-negotiable habits.
Here are the 4 pillars. First, reevaluate your strategy regularly, maybe once a quarter, but don't constantly re-optimize every time you have a losing trade. Second, monitor your live performance metrics against what your backtest said you should expect. Third, you have to accept that drawdowns will happen. Have a plan and don't panic. And finally, document everything. Trust me on this one. Your future self will thank you for it.
So as we wrap this up, I want to leave you with the one question you should ask of every single strategy you ever built. Is it built on a fragile peak or a solid plateau? By shifting your entire focus from chasing that one perfect backtest to building the most stable system you can, you dramatically increase your odds of success in the long run. Remember, the goal isn't a perfect past, it's a resilient future.